I need you to stop everything you are doing right now because what I am about to show you is going to sound like a complete impossibility. It's going to sound like two different realities existing at the same time. And by the end of this video, you are going to understand why a 12 price difference between two markets is the single most important signal in the entire precious metals complex right now. Here's what happened last week that nobody's connecting. On Friday, January 30th, 2026, silver crashed on the COMEX in New York. We are talking about a brutal 37% collapse from 121 down to 76 in a single trading session. Margin requirements were raised 47%. Forced liquidations cascaded through the futures market. Paper contracts were obliterated. Bloomberg called it a correction. Analysts said the rally was overextended. The mainstream narrative was simple. Silver got too hot. Speculators got wiped out. The market corrected. But here's the part they're not telling you. Here's the part that changes everything. While the COMEX was crashing, while Wall Street was celebrating their successful price suppression, while retail investors were panic selling their positions, something completely different was happening 7,000 miles away in Shanghai. The Shanghai Gold Exchange, where physical silver actually trades hands, where real metal moves from seller to buyer, where you can't just print contracts out of thin air, that market didn't crash. It barely moved. And right now, at this very moment, physical silver in Shanghai is trading at a 12 to 15 premium over the COMEX paper price. $12 doesn't sound like much. But what that number actually represents is the complete breakdown of the global pricing mechanism that controlled silver for the last 50 years. Let me show you why. Before we go further, you need to understand the pattern we're witnessing, because this isn't the first time a Western paper market has lost control of physical pricing. This is stage 3 of a 4-stage sequence that's repeated itself throughout monetary history. Stage 1 is unity. The paper price and the physical price are connected. The futures market in New York accurately reflects what physical metal costs in Shanghai, Mumbai, or Zurich. Arbitrage keeps them aligned. When the COMEX quotes $25 per ounce, you can actually buy physical silver for approximately $25. The system works because there is enough physical metal to back the paper contracts. Trust is high. The connection holds. Stage 2 is divergence. The paper market begins creating more contracts than physical metal exists to deliver. This is what the COMEX has been doing for decades. They're selling silver futures without having the actual bars in the vault. It works as long as most traders close their positions for cash and never demand delivery. The price suppression mechanism functions. The premium between paper and physical stays small, maybe 5-10. Manageable, controllable. Stage 3 is the awakening. This is where we are right now. Something breaks, a geopolitical event, a supply shock, a demand surge. Suddenly, buyers in the physical market start paying prices that have nothing to do with what the paper market says. The premium explodes to $12, $15, $20 per ounce. The arbitrage gap becomes a chasm, and the wealth transfer begins. Those holding paper contracts are getting one price. Those holding physical metal are getting a completely different price. Stage 4 is the divorce. The two markets completely separate. The COMEX becomes irrelevant, a sideshow for gamblers trading something that doesn't exist. While the real price, the physical price, is discovered elsewhere, in Shanghai, in Mumbai, in Zurich, anywhere real metal changes hands. Let me explain exactly what the Shanghai Gold Exchange is and why it matters more than any Western exchange right now. The C was established in 2002 and it operates under fundamentally different rules than the COMEX or the London bullion market. The critical difference is this. On the C, every transaction must be backed by physical metal. You cannot sell what you don't have. You cannot create synthetic paper positions. When a contract is executed, actual bars of silver move from one vault to another. This is not fractional reserve trading. This is physical settlement only. China processes more than 50% of the world's silver refining capacity. They're the largest manufacturer of solar panels, which consume over 200 million ounces of silver annually. They produce more electric vehicles than any other nation, and every EV contains 25 to 50 grams of silver in its electrical systems. China's industrial demand for silver is structural, permanent, and growing. Exponentially, they need the metal, not tomorrow, today, every single day. And here's what makes the current situation unprecedented. On January 1, 2026, China implemented the most aggressive silver export controls in modern history. They reclassified silver as a strategic dual-use metal, the same category as rare earth elements and defense-critical materials. You cannot export silver from China without explicit government approval. Only 44 companies have been granted licenses for the next 2 years. What this means in practice is that silver flowing into China doesn't flow back out. It gets consumed in Chinese manufacturing, stored in Chinese vaults, held by Chinese investors. It disappears from global supply. So when the C shows a $12 premium over COMEX, that's not just a price difference. That's China saying, your paper price is irrelevant. We'll pay what we need to pay to secure physical metal. Let me show you the actual numbers because this is not speculation. This is documented, verifiable, happening right now. As of February 3, 2026, the COMEX silver futures settlement price is $84.2 per ounce. That's the official price. That's the number Bloomberg displays. That's what paper contracts are trading for in New York. But on the Shanghai Gold Exchange, physical silver is clearing at $96.8 per ounce. That's a $12.6 premium. Not a 5% variance. Not a temporary dislocation. A 15% premium that's been sustained for over 3 weeks. And it's not just Shanghai. Physical silver premiums are exploding globally. In Mumbai, dealers are paying $13 to $14 above COMEX spot. In Tokyo, premiums hit $18 per ounce in mid-January before coming down to $11. In Kuwait, premiums exceeded $16. In South Korea, $9 to $12. Even in the United States, the supposedly most liquid silver market on the planet, premiums on physical products are at record levels. American silver eagles are selling for $98 to $102 when the spot price shows $84. That is an 18 premium on a 1-ounce coin. Canadian maple leafs are at $15 to $17 over spot. Even generic silver rounds, the cheapest way to buy physical, are trading at $8 to $10 premiums. Here's what this tells us. The COMEX can manipulate the paper price all they want, they can raise margins, they can force liquidations, they can create the appearance of a crash, but they cannot control what physical buyers are willing to pay. And physical buyers, the ones who need actual metal for manufacturing, for investment, for wealth preservation, they're ignoring the COMEX entirely. They're paying Shanghai prices, they're paying Tokyo prices, they're paying whatever it takes to secure metal. Now let me explain exactly how this arbitrage works and why it is creating the largest physical drain from Western vaults in modern history. Arbitrage is simple. When the same asset trades at different prices in different markets, traders buy where it's cheap and sell where it's expensive. They capture the price difference as profit. In theory, this arbitrage should eliminate price gaps quickly. If silver is $84 in New York and $97 in Shanghai, traders should buy COMEX contracts, take physical delivery, ship the metal to China, and sell it on the sea. That $13 profit per ounce, minus shipping and insurance costs, should attract enough arbitrage to close the gap. But here's what's actually happening. The arbitrage is flowing massively. Physical silver is being drained from COMEX warehouses, from London vaults, from refineries in Switzerland, and moving to China. Shipping data confirms this. Silver imports into China reached 287 million ounces in 2025, up 43% from 2024. In January 2026 alone, China imported 31 million ounces. That is more than a month's worth of global mine production flowing into one country in 30 days. And the gap isn't closing. That's the critical part. Normally, arbitrage eliminates price differences within days, sometimes hours. But the Shanghai premium has been sustained for 3 weeks and it's widening. Why? Because the supply of physical silver available for delivery at COMEX prices is running out. COMEX registered inventories, that's the silver available for immediate delivery against futures contracts, have plummeted 74% since 2020. We're down to just 26 million ounces, and that inventory is draining at an accelerating rate. Between January 7th and January 14th, 2026, 33.45 million ounces were withdrawn for delivery. That's 26% of registered inventory in 1 week. To understand why this matters, you need to understand how the COMEX actually operates and how they have been suppressing silver prices for decades. The COMEX is a futures exchange. When you trade silver on the COMEX, you're not buying silver, you're buying a contract that represents silver. It's a derivative. A piece of paper, or more accurately, a digital entry that says you have the right to receive 5,000 ounces of silver at a future date if you choose to take delivery. But here's the scam. Most traders never take delivery. They just speculate on price movements and close their positions for cash. This creates a system where the vast majority of silver trading is not real silver. It's synthetic, and because it's synthetic, the supply is essentially unlimited. The COMEX can sell 1 million ounces of paper silver with a few keystrokes. They don't need to have 1 million ounces of physical metal. They just need margin capital to back the trade. According to the latest data, the paper-to-physical ratio on the COMEX is estimated at somewhere between 100 to 1 and 250 to 1. That means for every ounce of physical silver actually available in COMEX warehouses, there are 100 to 250 ounces of paper claims against it. As long as only 1% of contract holders demand physical delivery, the fraud works. But when 2% demand delivery, when 5% demand delivery, the system breaks. There's not enough metal. And that's exactly what's happening right now. Delivery demands have spiked. January 2026 saw record delivery requests. The silver is leaving the warehouse, and the COMEX's ability to set the price is collapsing in real time, because you can only suppress a price if you can deliver at that price. When you can't deliver, the price you quote becomes meaningless. Let's walk through exactly what happened last week because the timeline reveals everything. On Wednesday, January 28th, silver was trading at $121 per ounce on the COMEX. The rally had been relentless. Retail investors were euphoric. Social media was flooded with $200 silver predictions. The momentum was unstoppable. Then Thursday came. The CME Group, which operates the COMEX, announced a 47% increase in margin requirements for silver futures. By Friday's close, silver had collapsed to $76, a 37% drop in one session, and the mainstream narrative was simple. The rally was speculative, margins got raised, leverage got flushed out, the market corrected. But here's what actually happened. The paper price crashed, the physical price barely moved. The Shanghai Gold Exchange showed physical silver trading at $89 that same day, not $76. The premium exploded to $13 overnight. Because here's what the COMEX can't do. They can't margin call physical holders. They can't force liquidate someone holding bars in a vault. They can't manipulate the price that Chinese manufacturers are willing to pay for actual metal they need for production. The paper market crashed, the physical market shrugged, and that divergence, that $13 gap, is the proof that the COMEX's price suppression mechanism is failing. They can still crash paper. They can't control physical anymore. Now let me explain exactly what this arbitrage gap means for wealth distribution. Because right now, today, the largest transfer of real wealth in the precious metals market is happening through this $12 price difference, and most people have no idea it's occurring. If you're holding paper silver, if you own SLV or other ETFs, if you have unallocated accounts at a bank, if you're trading COMEX futures, you're getting the paper price. When you sell, you're getting $84 per ounce. Your wealth is denominated in the suppressed, manipulated, artificial price that exists only on Western exchanges. You're on the losing side of the arbitrage. But if you're holding physical silver, if you have bars in a vault, coins in a safe, allocated metal you can actually touch, you're getting the physical price. You can sell American Silver Eagles today for $100. You can sell generic rounds for $92. You are capturing the premium. You're winning the arbitrage war. And here's the critical part. This wealth transfer is permanent. It's not a temporary dislocation that will correct. It's a structural break in the market that's accelerating. Every day, the Shanghai premium persists. Wealth transfers from paper holders to physical holders, from Western investors who trust the COMEX to Eastern buyers, who demand delivery, from speculators who trade contracts to industrial users who need metal, from those who think silver is $84 to those who know it's actually worth $97. And the gap is widening. 3 weeks ago, the premium was $8. 2 weeks ago, $10. Last week, $12. This week, $13 to $15. The trajectory is not toward convergence. It's toward divorce. The paper market and physical market are separating permanently. And when they fully divorce, everyone holding paper is going to discover their silver doesn't actually exist. Let me walk you through exactly what happens next, because the pattern is mathematically certain once stage 3 begins. We're not talking about timing. Nobody can predict exact dates, but the sequence is inevitable. Short term, the next few weeks, watch the Shanghai premium. If it stays above $10, that confirms the divergence is structural, not temporary. Watch COMEX registered inventories. They're currently at 26 million ounces. If they drop below 20 million, that's a critical threshold. Below that level, a single large delivery demand could drain the warehouse completely. Watch for more margin hikes. The COMEX will try again to flush out longs. But each time they raise margins, they're admitting the paper market is fragile. They're admitting they need to suppress demand because they can't meet it. Medium term, the next few months, watch for delivery failures. Not announced publicly. The COMEX won't admit they can't deliver. But watch for settlement delays, cash settlement offers above market price, contract rule changes that make delivery more difficult. These are signs the system is breaking. Watch for more aggressive export controls from producing nations. If Mexico or Peru, the two largest silver producers, implement licensing requirements like China, the physical supply available to Western markets collapses overnight. Long term, the next 6 to 12 months, we enter stage 4. The paper market becomes irrelevant. The COMEX continues operating, gamblers continue trading contracts. But the price they discover has nothing to do with physical reality. Real silver trades at physical market prices, Shanghai prices determined by actual supply and demand. The premium could hit $25, $30, $50 per ounce. At that point, the COMEX price is just noise, fiction, and everyone holding physical metal has won the greatest arbitrage trade in modern history. So what do you do with this information? Because understanding the pattern is worthless if you don't position for it. Let me give you the exact framework. If you're holding physical silver right now, you understand what you own. You are holding the asset that is trading at a 12 to 15 premium in the real market. You're on the winning side of the arbitrage. Do not sell. The premium is widening, not narrowing. Every week you hold, that gap gets larger. Your silver is getting more valuable relative to paper silver even if the COMEX price goes sideways. If you're holding paper silver, ETFs, unallocated accounts, COMEX futures, understand your risk. You're holding a claim on silver, not actual silver. And when the physical market fully divorces from paper, your claim gets settled at paper prices while physical holders get physical prices. Consider converting. Take delivery if you can. Move to allocated storage. Get out of the paper system while the arbitrage is still manageable. If you're thinking about buying, understand what you're buying. Premium products, American Eagles, government coins, carry $15 to $18 premiums right now. That seems expensive, but that premium reflects physical reality. The COMEX price is the fiction. The premium is the truth. You're not overpaying, you're paying what silver actually costs when you need physical delivery. And watch the Shanghai premium. I'll be tracking this weekly. When it hits $20, that's the signal. That's when stage 4 accelerates. That's when the paper market loses all credibility. Subscribe right now because what is happening in that 12 gap is the most important story in precious metals. The biggest wealth transfer in history is happening through a price difference most people don't even know exists. And by the time they figure it out, it'll be too late.